Hi, everyone. So I just wanted to touch base. It's Thursday evening. Uh, right now, we're looking at a scenario. There's a lot of different things going on in the marketplace, but I wanted to start off first with what's happening in realized volatility. Because remember, we were talking about this on Saturday, but we have started to see realized volatility creep higher, especially when we're talking about the shorter dated kind, the 9-day and the 21-day realized volatility have started to creep higher. And that's because you're seeing the S&P 500 gyrate a little bit more, and we're starting to see a little bit more movement in the indices. And I think this is really important because, again, remember, realized volatility is at very, very low levels. It's been very suppressed, and if it starts moving higher, that's going to start potentially pushing the VIX higher as market participants begin to anticipate higher volatility in the future. Additionally, we have to also remember that there's lots of systematic funds that run off of realized volatility, and when 21-day or 1-month realized volatility crosses above 3-month realized volatility, that's a very big signal for vol control funds to begin to perhaps start unwinding their short positions in volatility, or perhaps taking long positions in volatility. And so I just wanted to start off quickly with that, but I think it's really important also to take note that we are seeing some changes, at least in the dollar index. Remember, I was been talking about the potential here for rates to go higher, the dollar to go higher, to set up this pain trade into year end. And right now, the dollar's really been making a very strong move off of these lows. You can clearly see momentum favors further upside. And right now, we're just waiting to see if we can get above this 100 level on the dollar index. It looks like we put in some sort of double bottom pattern here. Certainly, we have a bullish divergence that's formed on the RSI. If you're able to get above 100, I think that's going to open up the doorway to potentially moving towards the 101 level. And I think this is important, again, because I think that could be a big pain trade as we head towards the end of the year. And a lot of the reason why we're seeing the dollar begin to strengthen again is obviously because of what's happening now with the yen. We are seeing the yen continue to weaken, and that's basically because of what happened over the weekend with the election and these ideas that perhaps the BOJ won't be as aggressive raising rates. Perhaps the government there will be looking to expand spending and issue more debt. And so that has the yen really moving up pretty sharply. But right now you can see we've stopped right around what I would call resistance, and also what looks to be overbought conditions, with the yen trading above the upper Bollinger Band and above 70 on the RSI. The other interesting thing that's really taken place over the last couple of days is we've seen this big move, HYG, really begin to weaken. And this is potentially an indication that maybe we're going to start seeing credit spreads really begin to widen out. We've talked about credit spreads in the past, and they are very important. And watching the HYG really can give us a good sense, an indication of perhaps what's going on there. I think what's important to know with the HYG is here's your 50-day moving average. Right now we're below the 20-day moving average, and we're below this big uptrend. And so this could be telling us a lot about what could be coming down the road. So right now we're going to watch to see if the HYG can manage to find support around the 50-day moving average, around this 80.25 level. If that holds, then we'll watch to see if it can come back and maybe retest this trend line. Obviously, if credit spreads start to widen, that's going to really tell us a lot of things, right? Because we're going to have tighter liquidity coming from a stronger dollar is going to tighten liquidity. You're going to have wider credit spreads. Guess that's going to lead to basically tighter financial conditions, and we know that risk assets don't like it when financial conditions begin to tighten. So watching the HYG now is very important thing to do. And if you take the SHY and you divide it by the HYG, you basically get what looks like a credit spread. And essentially this is a really easy way and a cheap way to just keep track of them. I mean, it's not going to be perfect, but for an inexpensive way to keep track of credit spreads, this works fairly well. You can always check out the ICE B of A high yield credit spread, option adjusted spread, but this is delayed basically by a day, so you're going to have to just wait and check the next morning to see if spreads are widening or whatnot. But if you want more of a real-time gauge, you can just do SHY divided by HYG to give yourself a little bit more of a real-time sense, and you can certainly get the idea that credit spreads are starting to widen when you look at it from that perspective. Also, again, we've been seeing a lot of weakness in different parts of the market also beginning to develop. Here's your KRE. regional bank ETF, that's showing some signs of weakness. We've seen a bunch of the private equity firms really start showing some weakness. This is Apollo Global. This has obviously been declining. Blackstone also really struggling more recently. If you take a chart of Blackstone and then you compare it to the S&P 500 over time, what's kind of interesting is that you typically see a stock like Blackstone peak before you see the S&P 500 peak. Certainly happened back here. You can see Blackstone peaked in September of 18 before the S&P 500 peaked. It certainly peaked back in here in February of 2020 before the S&P peaked. We also saw a peak here in November of 21 before the S&P 500 peaked. We also saw it even peak more recently back here in November of 24 before the S&P 500 peaked in February. And now we're seeing the same thing happening again. So we're going to want to pay close attention to what's happening here with some of these names. You're seeing the same thing with KKR, which is another firm here. You can see I have the dotted lines already there, and they're showing you the same exact thing. And again, what this is pretty much telling us is that there's something going on in the marketplace where we have private equity stocks really not performing well. We have credit spreads widening, and that could be something going on beneath the surface that we're not really aware of yet at this point. But it's certainly very important to keep an eye on this part of the marketplace. What also is important to notice is that the McClellan oscillator is now down at a negative 41 almost. We've really seen volume. We've really seen breadth really not do well. You can see 1,400 more decliners and advancers today. And this has taken the summation index down to just 310. And what we're going to pay attention to here is to see if we start getting more separation between these dots. If these dots really start falling in a more material way, meaning we start seeing breadth really stay really heavy to the downside, and we start seeing these dots begin to accelerate to the downside, that's going to really tell us a lot that the internals of the market are really deteriorating, similar to what happened here where these dots were rising really quickly. You saw that the market had a lot of strength. And in this period of time, if we go back, you can see during this period of time as we were coming down, the dots were really separating very quickly going into the end of the year. And then they were separating really quickly here, which really just gives you a sense of the speed and the pace and the strength of the downtrend that we may be in, or the uptrend for that matter. This, for example, was that October, November 2023 period of time where the market rallied, showing you there was lots of strength. So the spacing and the spacing between the dots is really what's kind of important here. Names, S&P 500, again, is pretty much stalled out right now. It's been just trading in this area between 6750 and 6700. We're seeing realized volatility moving higher, which is important. We're seeing dispersion remain elevated at really the upper end of the ranges historically. And again, we care about this because it's telling us what's happening from a volatility standpoint in the marketplace. We know correlations are very depressed. We know that realized volatility is starting to move higher, potentially signaling that maybe implied volatility starts moving higher. So a lot of things coming together here. We'll just have to see how things play out for the rest of the week, and we'll see you on Saturday. Bye.